All right, we need to pick up with where we left off before, and I've actually moved it back a couple of slides just to recap. We're looking at the adjusting entries. We're focused on accruals and specifically accrued revenues. With accruals, the cash flows after, so accrual after, AA. Cash comes after the revenue is earned or after the expense is incurred. In the case of accrued revenues, we earn the revenues. Cash has not been received yet. We're still going to recognize them as revenue. We're still with Comco. They're lending Zyco $10,000 on July 1. They will be repaid the $10,000 principal. That's the amount that is loaned, plus $1,200 interest for that year, that 12-month period on June 30th of the following year. So this is overlapping 2 calendar years, 2 fiscal years for the company. July 1 through December 31st is 6 months, and so we'll have 6 months in the current year and the remaining 6 months in the following year. So what adjustment must Comco make on December 31st this year end? Well, they're going to need to take the $1,200, divide it by 12 to get that on $100 a month, because revenue is earned each month that it passes. So the monthly revenue earned is $100, and since there are 6 months from July 1 through December 31st, that's $600 of earned revenue. Comco needs to record the adjusting entry to show that it has earned that $600 in revenue, and we do so by debiting interest receivable for $600 and crediting interest revenue for $600. Thus, what we have is an adjusting entry to accrue the revenue will be a debit to some revenue and to, a debit to a receivable and a credit to a related revenue. The blank there is because we have a variety of them. This one was interest receivable, interest revenue, but in addition to that, some other common revenues include commissions, so it would be commissions receivable, commissions revenue. Royalties, royalties receivable, royalties revenue. Rent, rent receivable, rent revenue. The adjusting entry increases assets when receivable is debited and increases revenues and therefore net income when revenue is credited. We need to take and think about what happens to the financial statements if the adjusting entry is not made. So if the accountant, the bookkeeper, does not make this adjusting entry, well, here's what we're looking at. When we debit receivable, that increases assets. So if it is omitted, then the assets will be understated by, in this case, $600. Revenue, if we fail to credit revenue, revenue will be understated, and so will net income by the amount of the entry, the $600. So we're going to have net income misstated when we fail to record an adjusting entry as needed. Back over here looking at our screen where we have the accruals and deferrals. Remember that with accruals, cash comes after the revenue is earned or the expense is incurred. With a deferral, the cash flows or the cash is before the revenue is earned or the expense is incurred. So we've already covered accrued revenues. Let's take a look at accrued expenses. Expenses incurred but not yet paid. Accrual after, AA. Cash will be paid after with an accrued expense. We have KTC. They pay its office staff $5,000 every 2 weeks. The final payday for the year ended October 31st, 2001 is Friday, October 24th. What adjustment is needed on October 31st, the company's year end? So this company has a year end of October 31st. So the fiscal year for this company runs from November 1st through October 31st. They're paid every 2 weeks, so it's a bi-weekly pay period. Friday is when payday occurs, and that happens to be October 24th. So there won't be another payday for 2 more weeks, which will take it into November. However, we have a few days there between well, after October 24th, which would be October 25th through October 31st. And we need to compute how much the expense is for that time period so that we can accrue that expense and get it in the current fiscal year. So looking at this, we've got payday being the 24th. They're showing that on there, and then they're showing through the 31st. So payday, the 24th. We now have the 25th through the 31st that we're going to have to take a look at. And we're looking at a 5-day work week, so they're not looking at the weekends. They're just looking now at the 27th, 28th, 29th, 30th, 31st. So we have labor costs, and they're paying office staff $5,000 every 2 weeks, so this is salaried. So if it's $5,000 every 2 weeks, if we divide 5,000 by 2, we're going to have $2,500 per 5-day work week. And we need to get that $2,500 in October in the current year, before year ends. All right, so we need this 1 week's wages, and we're going to debit wages expense for $2,500, credit wages payable $2,500. We may have also used the account salary expense, salaries payable. All right. The adjusting entry to accrue expenses then is a debit to an expense and a credit to a payable account. Once again, there can be a variety of expenses and payables. We just happen to be looking at wages. So besides the wages, it could be rent expense, rent payable, commissions expense, commissions payable, royalties expense, royalties payable. You get the idea. All right. The adjusting entry increases expenses, and therefore expenses reduce net income. This entry also increases liabilities. So we need to take a think about what will happen if the financial statements, what will happen to the financial statements if this adjusting entry is not made. So if we overlook this and don't make it, then if the expense is not there, expenses will be understated. However, net income will be overstated if you fail to record all the expenses. The payable, if we fail to credit payable, because it increases liabilities here, the failure to record this, if we omit it, then the payable or the liabilities will be understated. They will be less than what they should be. All right, back to our setup here. We've looked at accruals now. We have the two types, the accrued revenues and the accrued expenses. Let's look at deferrals. With deferrals, the cash changes hands before revenue is earned or the expense is incurred. And we've got two types. We've got the unearned revenues and the prepaid expenses. So let's look at the unearned revenues. The unearned revenues, we've received cash, but we have not yet earned it. So here we have on March 1st, Storage Co. rents out a unit and receives $900 for the first 3 months' rent. The company has a year end of April 30th. So their fiscal year ends April 30th. So it runs from May 1st through April 30th. March 1, it's rented out, $900, 3 months. Well, that's $300 a month. We have March, we have April, so we have 2 months in this current year, fiscal year for Storage Co. All right. We need to take a look and see what adjustment must be made on Storage Co.'s books on April 30th, the year ends. All right, the $900 payment received in advance can be recorded in two ways. It can be recorded as a debit to cash of $900 and a credit to unearned rents. So it is set up, remember, unearned rent is a liability. It's one of those few liabilities that do not have the word payable in it. Or we could set it up by debiting cash and crediting rent revenue. Now, We need to take a look at these two. Depending upon which way the transaction is set up for receipt of the $900 cash will make a difference in our adjusting entry. All right, here's a depiction of, we're looking at March 1st, the $900 is received. We're at April 30th for year end, and yet the storage rent is paid through May 31st. So 2 months, 2/3 has been earned, 2 out of 3 months, and 1 month, or 1 out of 3 months, is unearned. So we're taking a look at the two accounts. We have rent revenue, unearned rent. What we want to have happening, or what we want to see at the end, we want to have $600 in rent revenue at the end of the fiscal year, April 30th. And we want to have $300 in unearned rent as a liability because there's 1 month yet out of the total of 3 that has not been earned. All right. If the transaction is initially recorded to where the $900 all goes to unearned rent, then in order to wind up with $300 in this account at the end, we need to take and debit unearned rent for $600 and credit rent revenue for $600. So that's our transaction if it's initially recorded as a credit to unearned rent. All right. Now let's take a look. If it's initially recorded as rent revenue, we would have debited cash, credited rent revenue with $900, but we haven't earned all $900. We've only earned $600. So that means there's $300 that we need to transfer out of rent revenue to unearned rent. And we do so by debiting the rent revenue and crediting unearned rent. The entry would be the one you're looking at on your screen. All right, so it depends upon the setup. Either way is acceptable as an initial setup. So the adjusting entry that is made depends upon how the initial $900 payment was recorded. And they're just going to recap this. This adjusting entry reduces the liabilities, increases net income. And over here, this adjusting entry, the one where you're debiting revenue, reduces net income and increases liabilities. So if you need to, pause on this screen, ponder this, see if it's starting to click and make sense. Now, what happens to financial statements if the adjusting entry is not recorded? Well, if we do not record this debit to the unearned blank revenue, then it will since it reduces liabilities, without it, liabilities are going to be overstated. This entry increases net income, and without it, net income will be overstated. This one increases liabilities. Without it, liabilities will be understated. And this entry reduces net income. And without it, net income will be overstated. So keep that in mind. It may take a little while for this to be meaningful.